All right, everybody. Very good afternoon to all of you. It is 1st of January. Of course, it's a new year. So I'm hoping that everyone had a very good Christmas and everyone had enjoyed their New Year Eve. So I guess it's time to head back to the work and looking at the work we had not much going on from past Monday of this week, but we have some major key events coming up on Thursday and on Friday. So there aren't many, to be honest. So there aren't too many events that we can get excited about, but we do have U.S. Initial jobless claims. We have S&P manufacturing PMIs, and the most important one, ISM manufacturing and their subcomponents coming on Friday. Uh, we will go through one by one, but I think it's really, to be honest, it's really very wise, according to me, to go through what we had last year. Uh, where the central bank has left us and what bias we had last years for certain countries, starting with FOMC. uh, I do have that data over here on my desk, so let me just bring that up for you guys. Right here. So let me zoom it out for you. So if I quickly recall that we had uh, hawkish Fed last time. They cut it 25 basis point, delivered it, but it was, to be honest, widely expected they're gonna do 25 basis point of cuts. But here comes the key point. One of them member, Hamak, voted unchanged, which was very hawkish, because everyone expecting that the consensus gonna be everyone vote for a 25 basis point of cut at as usual. But one of the committee member voted for just one cut. Sorry about that. Just one of them voted for not cut, so leaving the federal fund rate. I think round about, if I'm not wrong. Okay, let me just show you. Close to 4.75%. So that wasn't just kind of overall picture. Is just one piece of the puzzle from a FOMC meeting we had. The statement wasn't a very hawkish, to be honest, but the projections they gave us was very hawkish. Starting with the GDP numbers, we had 2024, 2025, 2026. Almost they revised their GDP to the upward from the last time in September projections. They were expecting that the 2025 2024 GDP gonna end up staying at 2%, but they went hawkish 2.5 for 2025, 2026, and for a long run they stayed the same. But overall for 2024 and 2025, they showed that the economy expected to do better than they have thought in the September. Unemployment rate is expected that it's gonna get lower from 4.4 to 4.2, 4.4 to 4.3 for 2025, and for a longer run, they stick to the same numbers. Talking about inflation, they expect it to tick up. Uh, September projections for core PCE, you can see it was 2.6 and they revised it 2.8. The key component from all of this projections was the September projections, and from the current projections were the federal fund rates. Uh, they left their 2024 as this was the last meeting of the year, 4.4. But for 2025, 2026, and 2027, they increased their projections, saying that the interest rate, the Fed rate is gonna go, or let's just say it's gonna stay stricter than they have thought in September. 3.9, 3.4, 3.5, and for longer run 3%. It was a really market moving. If I just quickly bring up you the charts on the screen, let me just show you. Yep, right here. So equities really saw a nice bounce to the downside, down by 4.2% after that meeting. It's not just this, it was everywhere. Talking about the currencies, uh, I mean, you name it. Let me just quickly refresh this. So, euro dollar, US CAD, British pound against US dollar against Swiss franc. I mean, they just skyrocketed. Uh, okay, so the CAD and the dollar seeing nice 125 pips upside. So that was the move we saw from this FOMC meeting, and it was a very hawkish. And last part of that meeting was the presser, and the pressure was also really hawkish. The Fed was like the only key point which I highlighted. Let me just highlight it again. I think I highlighted it last time. Yeah. So in the Q&A, the chair Jerome Powell said that today's decision was a closer call, but the right call. Risks are two-sided. It was a really hawkish comment because everyone was expecting that it's going to be a anonymous cut, right? But saying that the today's decision was a closer call, like it was really hawkish. I mean, they couldn't have gone more hawkish than this. So there was another comment I highlighted here. Fed well, thinks economy is in a real good place and policy too. Timing and language in statement show they are at a point where they can slow or pace of rate cuts. We'll be looking for further progress of inflation to make those cuts. I mean, you read these comments and you're gonna feel like that, man, these are the hawkish comments. Like, well, just kept his guns and just shoot it at the markets. The other comment, I think it was a Fed looks at all financial conditions. The economy, it says US economy is performing well. And the last comment we had from the Powell was he retreats that from here is a new phase. The Fed is going to be cautious about further cuts. It is appropriate to proceed cautiously. So overall it was a very hawkish Fed. So that was the first central bank we talked FOMC meeting we had on I think 18th of December. The bank went really hawkish, and after that we just had Christmas holidays and New Year, so we haven't had any new data coming out of the markets. So with the Fed being hawkish with the Trump policies, especially he's using his tariff strategy to threaten the economies, that he's gonna impose really good tariffs on them if they don't negotiate on his terms. It's really threatening. So Antipodeans. Sorry about the Antipodeans. We will talk about that later. Not just Antipodeans, like the longer bias. Okay, the longer bias was that after Trump victory, it was expected that the dollar will go up. Um, and the expectations was that the Fed has to be hawkish because with the protectionism policies, if those get introduced from the Trump, it's gonna be inflationary, and with the inflationary policies, it's gonna create very hard job for the Fed to cut their interest rates faster than they have thought. So it's just like the FOMC, the Jerome Powell keeping his toes into that strong dollar narrative, by sticking, or let's just say by coming out on his last year meeting and saying that, hey, listen, we're not going to cut rates as aggressively as we have thought, because of the sudden changes. So, with that, uh, with that dollar strength, if I can also can show you the dollar index here. So, if let me just go for 4 hour chart, and yep. So, we had Trump victory. We saw a nice dollar strength. Okay, that was close to 4.4%, and then I think the market reversed from here, and then we had nice pull up after the FOMC. So I think you get the point, uh, that the dollar is gonna get strength, and how much is gonna get some strength, it's time will tell. But all I see, all I see is that it is currently trading almost 2 year highs. Okay, almost 2 year highs. If we go to the time period, okay, date range from here, I think it's 783 days, exactly 2 years, close to 2 years. So there is a huge gap we can see from here to here, but is it gonna get filled up very quickly? Well, we can show that, but we definitely gonna, well, maybe we're gonna see some pullbacks. Maybe the pullback's gonna come back to, maybe the pullback gonna come to right on this support before heading to the upward, and maybe something like that. But yeah, of course there is gonna be a strength that can get created with the perfect perfect economic conditions. So heading back to the economic calendar, just talking about the US, uh, let's just forget about 1st of January. We do have had some data coming out from China, but I mean, China is really struggling. They're trying to push it higher. They're introducing a nice fiscal stimulus out there, but I guess it's not, the market's not buying it right now. So the manufacturing PMI is just sticking to not that much, 51.5. January 2nd, we haven't had much till now, and tomorrow, the major event I am looking for from the US side. Okay, let me just see that why we haven't had any updates on here. January 1st, 2025. Okay, so these data is gonna get updated. Yeah, so not recent, I get this week. Yep, right there. There we go. So starting from Monday, we had some inflation reports. Don't worry about that. Let's just skip that. Uh, manufacturing and manufacturing PMIs. So it was coming out on December 31st. Second, as I said, these days are the days when you can see some volatility that can't be explained. So it is, I think, if you have a really nice experience with those environments, uh, you can trade it. But I think it's a really good idea to just stay away and have good days. Like you are almost at the end of the year and you don't want to screw up your nice gains just because you want to trade these numbers. Anyway, these numbers from China also came in, seems to me, closer to the consensus and to the previous. So let's just jump to January 1st. Not, I'm not impressed with these numbers. With the, no, these are the previous. Okay, so actual number we're gonna get from China manufacturing PMI, I think it's gonna be the last digit numbers, last update from December side. Uh, a good number here can create a nice opportunity in Aussie. I think the Aussie is really stretched to the downside. Uh, I'm really looking at some pullbacks in Aussie USD, but with the strength we are having right now in the in the Australian in the US dollar, I mean, it's just like I want to risk limited if I just want to see a pullback on Aussie USD. Any nice number here, I think can create a little bit pullback in Aussie USD. Just be careful with that. Just next thing is gonna be US initial jobless claims data. So I mean this data has created some of some of the nice trading opportunities out there, but if I really want to trade this data, I want to see the numbers coming close to 250. Okay, either close to 250 or below 190. I want to see something maybe 180, 190 to just to get into the dollar longs. Okay, and what will I choose? I probably go for USD Swiss franc if I get a nice strong labor data over here. Now with that being said, let me just put it out of the way. S&P Global Manufacturing PMIs from Canada and US. I mean, don't bother about. Just forget about it. Let's move straight to Friday, last day of the week. Just expect that in the first week we usually have very thin liquidity because of the majority of the traders just enjoying their nice nice how I can say that holidays, and just think about like they're just coming back to their desk and looking around at what's going on in the markets. They just don't want to, those big players don't, I think they don't just rush into, but we don't know. It's all right, these are all our assumptions, expectations that how things can go, uh, but I think that if anything happen in ISM manufacturing PMIs, I mean, if it comes out from contraction to expanding territory, and it has really it had really hard times from past again. I think it's 1 year or close to 1 year, and any number above 50 dollar strength, we're gonna see that amazing numbers gonna be those gonna be with don't forget, we it's not about just these numbers. We look at these subcomponents, especially employment, because it has to do with the labor. Okay, new prices, prices has to do in inflation, new orders, all of these data must come in line with these numbers. Then it creates a tradable, nice tradable opportunity where we can sum one-sided volatility. So as I said, anything close to 50, I'm more than happy to get into the trade again. Strength in a dollar, this is Swiss franc is what I'm looking to get into. But we will see Friday where we get, and with that, I think that's it. We're not gonna have much data, just ISM manufacturing and some initial jobless claims coming out from US. Those are the major data I'm focusing on for this week. I haven't had looked at the next week what data we're gonna have out of from major developed countries, but let's hold our horses for a moment and just focus on ISM manufacturing PMIs and the and the labor data we are having on Thursday. So with that being said, you all traders have a very good evening, and if you have any questions, as always, don't hesitate to let me know.